Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Jen Josie. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Jen Josie. Listener discretion is advised.
Hi, and welcome back. I'm Jen Josie, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have a guest that will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is accountability partners. It took me way longer than it should have to realize the importance of an accountability partner. When I first left corporate America to run our business full time, I was overwhelmed with all the freedom I had in my day-to-day activities. I turned off my alarm and was doing whatever I wanted whenever I felt like doing it. I had business tasks to do, but took my time to getting around to them. After a while, it also became lonely. I was missing out on that water cooler talk with coworkers. Within a few months, I reached out to some other investors in our local meetup group and started having lunch with them every other week. We then started to share our goals. Did you know that when you write down your goals, you have a 42% higher chance of achieving that goal? When you share that goal with another person, that raises to over 80% chance of achieving that goal. So if you are in a slump and want to increase your success, an accountability partner can give you that much needed kick in the ass when you need it. Now on to today's episode of the Real Estate Investor Growth Network podcast. We have with us my new friend, Erik Oliver. Erik holds a Bachelor of Applied Science in Accounting from Westminster College. Prior to joining Cost Segregation Authority, Erik was an operations manager for a multi-million-dollar landscaping and design firm in Long Island. Since heading west and joining Cost Segregation Authority, Erik has been speaking at local, regional, and national events. He brings with him a passion for identifying cost savings and educating real estate investors on the benefits of cost segregation. I have a lot to learn on this episode, so let's get started. Welcome to the show, Erik.
Thank you. I'm glad to be here. Thanks for having me.
I have so many questions. Now, just so you have a little background on me, I married an accountant because that's my least favorite thing to do. So when you start talking accounting, I'm like, la, 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 I start zoning out. But anyway, let's get a little bit of background on you. You're in Utah. Tell us about Erik.
Yeah. So as you mentioned, my degree's in accounting. So I never, my degree was in accounting only because I hated writing papers in college. Let's be honest. I struggled at writing papers. I was always somewhat good at math. And so I'm like, how can I get the hell out of here? Oh, I know what I'm going to do. It's either going to be finance or accounting because those are the two things I understand. So that's why I have a degree in accounting. I didn't actually think I would ever use it until I had been living out in New York and was looking to come back west to Salt Lake, where I live now, and came across this job. Always been interested in real estate investing. And so came across the job that was a business development job, but it required accounting knowledge, and it was in the real estate industry. And I thought, well, what a great idea. And so I didn't even know myself what cost segregation was. So before I came and interviewed, I'm like, I got to figure out what this is. It sounds amazing. So watched a few YouTube videos and was able to educate myself enough to get through the job interview, and fortunate enough to land here. I've been here about 7 years. We work with CPA investors and real estate investors and CPAs across the country on helping reduce their tax liability by utilizing cost segregation. And so that's a little bit about me.
All right. So I had to talk to the Google and say, what is cost segregation before this? And here's the definition that I was like, okay, that makes sense. So cost segregation is a commonly used strategic tax planning tool that allows companies and individuals who have constructed, purchased, expanded, or remodeled any kind of real estate to increase cash flow by accelerating depreciation. You're gonna have to explain that one to me. By accelerating depreciation deductions and deferring federal and state income taxes. So I know there are so many different tax laws out there, and I'll try and stay awake through this, but you are a great person to explain this. So dumb down that definition right there. What exactly is cost segregation?
Yes, that's a great question. It's a question I get from my kids all the time. They're like, Dad, what the hell do you do for a living? So I'm going to give you the version I give my kids. Okay. So when you buy real estate, you buy a whole building. And so I tell my kids, when we go to McDonald's, we buy a whole hamburger, right? We buy the bun, the patty, the pickles, the ketchup, everything that's on there. Cost segregation is just putting values to those different pieces. So instead of buying a Big Mac for, I don't know what a Big Mac costs these days, $7, you're buying a bun for $1.25. You're buying a meat patty for $2. You're buying a pickle for 75 cents. Same thing in real estate. When you buy a building, you're not just buying the building, you're buying some carpet, you're buying some countertops, some cabinets, some flooring, some appliances. The IRS has different buckets that we should depreciate these assets in. So, for example, carpet should be depreciated over 5 years, not the typical depreciation of a building, which is 27 and a half. So let's talk a little bit about what depreciation is, because I know that's your next question.
You just kind of fixed it right there, because I was like, when I'm buying real estate, I'm always I'm forcing appreciation on the building, but you are talking about the parts of the building. So that helps me to begin here. So, yeah. So keep going. No,
great point. Land and walls typically go up in value, but the countertops and that washer and dryer in your single family home goes down in value. And so the IRS actually, all real estate depreciates according to the IRS. So even your brick on the outside of your building is less valuable year 10 than it was when you bought it, because it's starting to deteriorate. So real estate typically, according to the IRS, is depreciated for commercial buildings over 39 years and residential units 27 and a half. So I'm just going to make the math easy. If I buy a $275,000 home, I get a $10,000 depreciation expense every year for the next 27 and a half years. Now that $10,000 comes off of my income, which means I'm taxed on $10,000 less than I would be, because I have this depreciation expense. So it's a good thing that the IRS allows us to do this. It's not that your building is really coming down in value.
Okay.
It's just that at some point you're going to have to replace the bricks, you're going to have to replace the appliances. And so the IRS basically gives us credits or deductions. They're not credits, they're deductions for that depreciation of those assets. Well, if I buy a building, I buy this single family home for $275,000, a $10,000 write-off every year is great. But what if I can front load that deduction? I might not own the building in 27 and a half years. So I want my deductions now, especially with inflation. $1 today is worth more than $1 10 years from now. So give me my deductions now.
Okay.
And so the way that's done is through using cost segregation, which is an engineering-based study where we come in and say, okay, yeah, you bought the whole thing for $275,000. But when you bought it, there was $10,000 worth of carpet in there. Now, carpet, according to the IRS, shouldn't last 27 and a half years. It only lasts 5 years. So I get to take in theory, 1/5 of my carpet as a deduction every year. Oh. So now that I front load this or put it into the appropriate buckets and front load this depreciation, I get bigger write-offs in the early years, which means instead of a $10,000 deduction on this home, I might get a $70,000 deduction in the first year, which means I get to reduce my taxable income by $70,000, which saves, significant tax dollars. So hopefully that gives you a better understanding of what cost segregation is. And it's really just in the name, right? We're segregating the costs of your purchase. So
what type of items in a house depreciate quicker than others?
Great question.
I just came up with that.
That was great, off the top of your head. There's really 4 categories. So when we do our studies, we're looking at 4 major categories. You have your 5-year assets. That's all basically a lot of your interior stuff that's not screwed down or structural, right? So your carpet, your countertops, your cabinets, your appliances, lighting, ceiling fans. Then we have some 7-year assets. There's typically not a lot of 7-year assets. That's like your telecommunication lines that are coming into the building and cable lines. Then we have our 15-year assets, which is another big category. That's all your exterior land improvements. So your driveway, curbs, gutters, asphalt, fencing, irrigation, outdoor lighting. We get to put all that stuff and depreciate it over 15 years. And then whatever's left over falls in that 27 and a half or 39-year category, which is a long-term asset.
Wow. All right. So how does this apply to someone who just flips houses? Does this even apply to them?
That's a great question. So when you flip houses, typically you don't take depreciation on those assets because they're never placed into service. However, if you flip houses, and let's say I make $100,000 this year flipping houses, but I have a long-term rental over here on the side that I rent out, I can do a cost seg study on that rental property, create a deduction, use that deduction to offset my flip income and pay no taxes on that flip income. So a lot of flippers that we work with, they might flip 4 or 5 houses a year, but they're holding on to 1 or 2 of them so that they can use these deductions to offset that rent or the flip income. And then they might sell them off in a year or two, the other 2 that, they don't want to get into the long term, but holding 1 or 2 of your flips might make sense from a tax perspective if you've got significant flip income because you don't want to have to pay high taxes on that income.
Interesting. And so I know your company, Cost Segregation Authority, you create these, when you go and you research or a company, what is it? A study. You do studies.
Yeah, we do studies. Correct. Yep.
Okay. Now, would a regular we have 20 doors, but we also flip out. Well, we're trying to get out of flipping houses, but would that be something of my level to hire someone like you to do a study on our business?
Yeah. So, that's another great question, because in the past I would say no, because the cost of these studies was significant.
Right.
You were talking $10,000 for a study. And so you had to have a pretty big building to absorb those costs. There's been one major law change. When Trump was in office, he overhauled the tax code, or some of the tax code. And obviously Trump is a real estate investor. So when he overhauled the tax code, it was very favorable to real estate investors. So something came into play called bonus depreciation. So under the current tax law, bonus depreciation allows you to accelerate those 5, 7, and 15-year assets at an even faster rate.
Oh.
So instead of your 5-year assets, dividing it up by 5 years, in 2023, you actually get to take 80% of those 5-year assets, 80% of the value, and write it off in the first year. The other 20% gets spread out over the next 4 years. So you're getting even a faster deduction by using bonus. And so because of bonus, it now opened up cost segregation to almost all investors of all shapes, sizes, and values. So again, we used to not do single family homes 5 years ago, but now because the tax law changes, we do, a $200,000 single family home. You might get a $60,000 or $70,000 deduction by doing a cost seg study, which if you're at a 30% tax bracket, $70,000, that'd be a $21,000 tax savings. And that study might only cost you $3,000 or $4,000 to do versus, $10,000. So I'll pay $3 to save $21 all day long.
Absolutely. Oh my goodness. So I'm going to be honest. I am not a fan of Trump, but what we're discussing here is a lot of people who just don't know. There are so many tax savings out there because people say, oh, they didn't pay anything in taxes. They didn't do this because it's not working a system. It's just knowing the tax law, correct?
No, you hit it on the head.
Yes.
As I've been doing this over the last 7 years, I was with you. I'm like, how are these companies not paying taxes? Or how are these businesses not paying taxes? And I've realized as I've started to learn the tax code that our government, very little pages in the tax code are things that you have to pay for, right? It tells you there's very few pages that say, this is what we're going to tax you on. There's a lot more pages in the tax code that say how to avoid taxes. And all those pages are pages telling you, incentivizing you to do what the government wants. So if the government wants more green energy housing, they're going to give you a big fat credit for building houses that are green energy, right?
Or creating jobs is another one.
Or creating jobs, or the keeping the housing market rotating and keeping that going. And so really the tax code is devised to incentivize us to do certain behaviors. And if you do those behaviors, the government rewards you with these deductions or tax credits. And so owning real estate and creating jobs and creating value by owning real estate is something the government wants us to do. And that's why they've put these things into place.
And, it really does drive me crazy because people are just like, well, they're avoiding this. They're not avoiding it. They're just using it to, their credit to make more money. But it's because exactly what you said. So thank you for explaining it. Explain it that way. So a lot of our listeners are just getting started in real estate, but we do have some that do several flips a year, have lots of doors, etc. So someone like me, I'm getting ready I want 101 doors. I'm manifesting that. I want 101 doors by the end of the year. This is something where people who have long-term rentals, this is going to be more of a necessity that we're going to start needing in our life, correct? To run a study on our business?
Yeah, no, absolutely. Because, to get to that 101 doors, what if we can free up $200,000 that you were planning on paying in taxes?
Talk dirty to me, Erik.
Right?
Okay, say that one more time because I just got really excited. Whew. So you could save me money by spending a little money on this. I cut you off. Sorry, I got really excited. So
no,
say that again. Say that again because that was so good.
Yeah. That's how investors grow their portfolios at a faster rate, is by utilizing these deductions to their advantage. So cost segregation creates cash flow, and cash is king. And you can now take that cash that you were just going to let the IRS hold on to for the next 27 and a half years. And they're not going to come tell you, hey, you need to be doing this, because they want that money in their coffers. By doing cost segregation, accelerating this depreciation, we create cash flow. Instead of you paying $80,000 at the end of the year to the government in taxes, you're going to get that back as a refund. You're going to take that $80,000 and you're going to go put it down on a new fourplex. And then when you do that fourplex, you're going to do a cost seg study on that fourplex. You're going to save the money, and you're just going to keep doing it over and over and over. So that's the strategy. I'll give you a real case. This is a real case example. I have a tax problem. I'm going to have to pay the IRS here in April. And instead of paying them, I went and bought a property at the end of last year. I'm going to do a cost seg study on it. I'm still coming out of pocket, whether I still had to come out of pocket for the down payment, but I would rather spend my $80,000 on a down payment versus sending that $80,000 to the government. Either way, I'm out of pocket $80,000, but because I did a cost seg study, I'm getting my tax money back, using that to put down on a revenue generating property that should appreciate over time. And I'm starting to build my portfolio out.
And it's so much better going into your portfolio as opposed to paying it to the government. So
yes, exactly.
Excellent. All right. So very general here. What are some tax implications for real estate investors? What should we be watching out for?
Well, one thing I just want to tie together with cost segregation, because it's a question we get asked quite often, is do I have to pay this money back? So, and the reason people ask us that question is when you sell your asset, there's two types of tax you pay. You pay capital gains tax, and you pay what they call depreciation recapture. And depreciation recapture tax is calculated on how much depreciation you've taken. So I'm sitting here telling you, Jen, take all the depreciation you can. And people are like, wait, hold up. When I sell it, don't I just have to pay it all back? And the answer is no. And I'll kind of back into that here in just a second. But the idea is take the deduction against your ordinary income. So let's say you're in a 35% tax bracket. You're going to take your deduction at 35%, pay back a portion of it at a lower rate at a future date, and save the spread. So you're going to pay it back at a capital gains rate of maybe 15 or 20% and save that 15% spread. Now, you don't even have to pay it all back. And here's the reason why. If I buy a building for $1 million and 5 years later I sell it for $2 million, when I go settle up with the IRS, I'm telling them that everything doubled in value, right? I bought this apartment building for $1 million. I sold it for $2 million. So everything must have doubled in value. Well, my land doubled in value, my walls doubled in value, but that dirty, nasty carpet in the front room that's stained didn't double in value. That goes down in value,
Okay.
right? Carpet is a 5-year asset. What is my carpet worth after owning it for 5 years, according to the IRS?
Zero.
Or zero,
Okay.
right? Has zero book value. So I don't end up having to pay a gain on that carpet because that carpet's not worth more than it was when I bought it 5 years ago. But if you don't do a cost seg study and you just sell this big wrapped up asset as doubling in value, you're telling the IRS that everything in that asset also doubled in value and you're paying tax on it. And so don't, and I know that's about as far in the weeds as we'll get, Jen, I promise. But
Okay.
if you remember anything from what I just said, don't pay tax on your dirty, nasty carpet. And that's what you're doing when you don't do a cost seg study and your building appreciates. You're saying, hey, my carpet appreciated too, and tax me on it. And you don't want to pay tax on your dirty, nasty carpet.
Ever. I don't even want dirty, nasty carpet. No, I guess I'm going
right?
to just
let alone pay tax on it.
Man, what a in the weeds topic here. And you make it so much easier to understand. I'm learning so much. And so I had to ask my husband, the accountant, I'm like, what is cost segregation? And la, la, la. And he's like, oh, it's a, and I'm like, well, why would you want to depreciate the value of your property? But it's really just, okay, the components of it.
The tax purpose, yeah. I'm still trying to figure out how you found a CPA that has a personality.
Well, I am the looks and the mouth of the business. He does all the paperwork and does this.
I kid my CPA friends out there. There's just this bad rap that we don't have any kind of personality, but I know a lot of CPAs that have a lot of personality. Well, so I kid my CPA friends.
My husband also lost his hair like you did. So, he's got you said with my shiny forehead here, I'm like, yeah, I'm used to looking at that. So
Jen, we're not supposed to, this is audio only. No one's supposed to know that I'm bald. For all they know, I look like Fabio. Half your audience won't even know who Fabio is.
Butter. It tastes like butter. Isn't that what he did? Anyway. All right. So what are some things that newer folks that maybe they don't have I don't even know if you can even answer this question, but if they don't have buy and hold yet, they're just starting this business, what are some things that they need to start keeping in mind? I mean, you touched on 1031 exchanges. That still confuses me. And you have to own a property for more than 2 years or something for 1031 exchanges. And actually it's not that bad, whatever, depending on the tax bracket. Am I correct in saying that?
Yeah.
Okay. So what are some things people getting into real estate investing that they need to start kind of keeping an eye on to help with their tax liability down the road?
Yeah. I think the biggest thing is even in our world that we live in cost segregation. So cost segregation, when we do these studies, our deductions that we create cannot be used to offset my doctor income, for example, or my teacher income, or whatever my occupation is. So cost segregation or depreciation doesn't always allow those deductions. There's two types of income. We have active income and passive income. And for me, as an employee of this company, I have a W-2 job, so my rental properties are considered passive. I do them on the side.
Right.
My active income is my W-2 income. When I do the cost segregation studies, they can't always be used to offset my W-2 income. And so while it is important to think of cost segregation, it's not for everybody. And there's some things there's ways around that. There's a short-term rental loophole. There's a lot of times high W-2 earners have their spouse become real estate professionals for tax purposes. And that changes the rules dramatically, saying, hey, me and my spouse do real estate for a living. And so now when I do these cost segregation studies, or I have depreciation expenses, they can be used to offset not only our rental income, but also W-2 income, because me and my wife file a joint tax return. So you always want to run past these scenarios with your CPA, because they know about passive income, active income. They know about your situation specifically. And so my advice would be just know that getting into real estate, it doesn't mean you're going to offset your high W-2 income necessarily. There's certain rules you have to apply to.
Very well said. And what is the short-term rental loophole?
Yes, I'll give you back to the example I gave you with myself. So I'm a W-2 employee. My wife is a W-2 employee. Real estate typically can't be used to offset our W-2 income. However, if I buy a short-term rental and meet a couple tests, one of them being the average stay is less than 7 days, which it typically is for Airbnbs. The second one being that I show material participation in the management of that property. And there's 7 ways you can do that. You can Google 7 material participation. You can find them out there. The material participation test that me and my wife met was we closed on the property in November. We had to spend 100 hours at the property doing work or managing the property, which it took us more than that just to get it staged and ready to go. And we had to spend more time than anybody else on the property in that year. Well, we only had a couple rentals in 2022 because we just put it live in December. So the cleaner was only there a couple times. The maintenance guy was only there a couple times. And so we were able to put our 100 hours in, have more time than anybody else, which is the second test. Because of that, it's basically like we own a hotel business or we own a short-term rental business, and that has a different set of rules, and that's considered active income. So now when I do my cost seg study on my short-term rental, it's going to create about $140,000 deduction. I'm going to take that $140,000 and I'm going to wipe out $140,000 of me and my wife's income for our taxes, which is going to save us at a 35% tax bracket. What's the math on that? That's a hard question. 145 times 0.35. It's going to save us $50,000 in taxes.
Wow.
Which was almost my down payment.
So we just bought a quad that we Airbnb, but we do 30-day rentals on 2 of them. So that would not apply to this?
The 2 wouldn't, but that we would take half of it and you would be able to take half of those deductions and use it to offset you and your spouse's W-2 income if you guys don't meet the real estate professionals side of things. So yes, you could.
So, but it will change next year because we are not going to be there more than whatever the 100 hour, because it'll be full of guests next year.
Right.
So it would only be for
fine.
2022.
Yeah, you would do it for, like, we're doing it for 2022. In 2023, the cleaner and the maintenance people might be there longer than me, but that's fine because I've already banked and used those deductions in 2022. So the deductions in 2023 are going to be significantly smaller, which is fine because we'll use that to offset the income from the property.
This is amazing. Erik, thank you so much for sharing this and really dumbing it down for me, because I was like, what? Why would I want to? Because you work so hard to force appreciation on a property, especially if you're going to go and sell it on the back end. But and it also makes me start thinking people who own multifamily who are getting ready to sell at, say, the 5-year mark, they don't want to. So I'm buying a property that has carpet that needs to be replaced, has stuff that needs to. So then when I buy it at that $2 million mark, that we're just going to use the same example you used before, when I'm buying at $2 million, I can then force appreciation by replacing carpet, by doing those things, correct?
Right. Yep. Exactly.
We are best friends now. This is fantastic. And it's such a topic where, thank you for, explaining it in the way you do, because I could have fallen asleep during this interview. So I do appreciate it. Well, the second half of the podcast is what makes Erik Oliver a badass. And I use the acronym BADASS. And the first letter is B for book. What's a book that's made a huge difference in your life?
That's a good question.
I love this.
I'm trying to remember the name of the book. It was written by Tom Wheelwright. Tom Wheelwright, he speaks across the country. What's the name of the book? It's like I have it here somewhere. I'll have to find it. It's something wealth. Yes, you put me on the spot. I'll get you the name and you can put it in the notes, but it's by Tom Wheelwright. He's written a couple books.
Tax-free wealth? Win-win wealth?
Tax-free wealth. There you go.
Okay.
Tax-free wealth. You got it. Tax-free wealth. So tax-free wealth is, Tom is really the one who kind of, after reading that book, made me realize that the tax code is really written to incentivize people to do certain things. And he breaks it up into quadrants, and you can fall in one of these 4 quadrants, and 2 of the quadrants have very favorable tax advantages and how to get into those quadrants. And so that's probably one of the books that's really changed the way I look at real estate in general.
Good. And by the way, my husband, who's the accountant, he doesn't even like to read. So I'm just impressed that you read other books. All right. The first A in badass is for advice. What's the best piece of advice you've ever received?
Um, I'm going to switch the question slightly and just say I
Okay.
didn't receive it. I had to learn it myself the hard way. I probably did receive it at some point from my parents, and I just didn't listen. So then I had to learn it the hard way. But know your weakness and outsource your weakness, meaning I know that I'm not a good marketer. I don't know anything about marketing. I could sit and try to put together flyers. They're going to look childish and ridiculous. So outsource that. Be willing to pay to outsource that because it's going to pay tenfold on the back end. And so know your weakness and be willing to accept your weakness and say, hey, I'm not very good at, organization, or I'm not very good at phone calls, or whatever it is that you're not good at. If it is part of your business model, find somebody who is and be willing to pay them to do that because, it's going to make a big difference in the back end.
And I think that's such great advice because there's so many people who, when they get involved in starting their own business, they do these $10 an hour type jobs from themselves. Right. When that $10, you can pay that to somebody else to do. So that frees up your time, which is more valuable to do what's most important. So excellent advice there. I love it. All right. The D in badass is for drive. What drives you to be successful?
I would just say my family. I mean, I've got a couple young kids, and so obviously trying to grow my portfolio and leave something for them, try to pay as little in taxes so that I can grow it faster and leave a little something for my kids would be great. And then just doing what's right. I'm a firm believer in karma. I believe that, the truth always comes to the top, and it might not come to the top now, but it'll come to the top at some point in your life. And so just doing what's right is always what's kind of driven me in both business and my personal life.
Excellent. I love that. All right. The second A in badass is aspiration. I'm a big goal setter. So what is a goal you are currently working on? It could be business or personal or whatever.
Yeah. So one goal that I have for I'm so bad about New Year's resolutions because they never ever. I'm surprised I've done it as long as I have. What is it? The 19th? Oh, today's the 20th. So I'm 20 days into it. But one thing that I know I need to do is just more self-care for myself. I get caught up in being a father, being a husband, being an employee, and oftentimes lose focus of what I need to make myself a better person. So just taking the time to do what I need, to exercise, to do stuff that I enjoy, it actually makes me a better employee, better father, and a better husband by taking care of myself. So putting myself not necessarily first, but at least acknowledging that there is some self-care that needs to be done there.
Yeah. And so many people ignore that. They are wanting to make everything better for everybody else that they forget about themselves. And you can't be better for them unless you take care of yourself. So
that's
excellent.
Exactly right.
All right.
Well said.
Yes. The first S in badass is systems. I love this question. So what systems do you have in place to help you achieve success?
So I'm horrible at systems. I'll be the first to tell you. But I also know that systems are extremely important. Just in our business here, those of us who have succeeded have put systems into place. And so I'm all about consistency and I think consistency makes a big difference in, at least for me, in being successful. If I'm consistent and I know, okay, when I do this, I got to do these 5 steps after it. If I don't do those 5 steps after it, I'll forget and things fall through the crack. And so having systems or processes in place, both in business and my personal. I mean, my wife will tell you opposite. I'm horrible about like every Sunday morning I go to the same gas station and the same car wash because I need to get my car ready for the week, right? And so I'm very process driven and almost to a fault where sometimes it drives the people around me nuts. But processes are important. Systems, I'm not so good at putting systems in place. I understand the importance of it, but that was probably not the best answer to your question, but they are very important. I'll just leave it at that.
Absolutely. Absolutely. All right. So to wrap up this portion right here, the final S in badass is for success. What does success mean to Erik Oliver?
The definition of success has changed probably in the course of the last 10 years. Well, probably how old am I? Probably the last 20 years. I mean, coming out of college, it was all about, I want to make money. I want to be successful. That's what I equated success with, was money. I've learned as I've gotten older and wiser and grayer and balder, that success is not so much about money. It's about your time. Time is limited. And so, yeah, I can stay at work late tonight and probably, sell another cost seg study, but my kids are only going to be in the house for a few more years. They're going to go off to college or go do what they want to do. And so spending that time, success to me is more of a well-rounded, not just in my personal life or my employment, but also in my family. I kind of look at success as more of me being happy, providing for my family, making my family doing my part to make my family happy. Obviously, everyone's happiness is up to them, but doing my part to be successful in that is kind of my definition of success at this point in my life.
Well, I think it's an excellent definition. It has been a pleasure to have you on the show. So, Cost Segregation Authority, is that a national company?
It is, yes. So we do studies in all 50 states. So I like to do studies in Hawaii. I've got colleagues who we pass the South Dakota studies to. So I kid all my friends in South Dakota. It's just I don't like going there in the winter. That's all. So I love South Dakota, just not in the winter. So
I have a student in South Dakota who says,
that?
I have a student in South Dakota and she's always complaining, how nobody ever comes out this way. And as she's saying through shivering teeth. So yes, right. But so Cost Segregation Authority, how do people find it? How do they get there to get a study and get in touch with you, et cetera?
Yeah, so I can be reached, the best way is through our website. So we have a website, www.costsegaauthority.com. All of our contact information, my contact information's out there, as well as there's a link you can click if you've got a property you think might be a good candidate. One of the things that we offer is we do a free analysis on any property or any portfolio of properties. So reach out to us. We're happy to put some initial numbers together. We don't want to ever engage anybody if they're not going to save significant tax dollars. So we always run that analysis first. And then once you have the analysis, you can share it with your CPA, your tax preparer. We can decide if this is a good year for you to take advantage of the cost segregation study and then go from there. But please feel free to reach out to me on any questions, any real estate tax related questions. Don't call me and ask me about child taxing credits. I know I'm from Utah and there's a feeling that Utah has a lot of children, but I don't know anything about child tax credits because we don't do tax returns at our firm. We just do cost segregation, but anything depreciation or real estate related, I'm happy to help any way I can.
And just to clarify, and you kind of did this already, but you can look at an entire portfolio. It's not just if we have one. And is it, so I have a 12 unit in Virginia, for example. You used to live up in Richmond. So this is one where, do I just say, hey, can you do cost segregation on this building? Or do I hand you my whole portfolio to do it?
It depends. So probably to get the initial analysis, I always recommend give us the whole portfolio. So nice. There's certain documents we can pull from your tax return that help give us the information we need. I like to run the numbers on everything because then let's say you've got 5 properties, you can say, okay, well, this property is going to get me $200,000 of deduction, but I really only need $80,000. Well, let's do this other property this year. And let's save those properties. We don't have, just because we run the analysis, we don't have to do all the properties. We can pick and choose. That's the great thing about cost seg is you just keep it in your back pocket and you pick and choose when you utilize those deductions. And you don't have to do all the portfolio at the once. You just do 2 properties this year and save 2 for next year. Or maybe this year you didn't make a lot of money, but next year you plan on making a lot of money because you're going to sell your business. You're going to have a huge income. So let's do it next year when you're in that higher tax bracket.
This has been fantastic, Erik. Thank you so much for your expertise on this. It's been such a pleasure having you on the show.
Oh, no, thank you. I appreciate it.
Yes, absolutely. And that is all. Thank you for listening, and we will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to RAIN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josie by visiting therealjenjosie.com or become a member of RAIN by registering on rainmastermind.com.